The American dream is crumbling beneath our feet, and Home Depot, the very company that built its empire on home improvement, just sounded the alarm that our economy is in freefall. Home Depot CEO Ted Decker's recent warnings about ongoing pressure on large remodeling projects and uncertain macroeconomic conditions aren't just corporate speak. They're a desperate distress signal from a company with its finger on the pulse of American home ownership. When the nation's largest home improvement retailer tells investors that consumers are postponing renovations and large projects, it's time to pay attention. What we're witnessing isn't just a housing slowdown, it's the beginning of an economic avalanche that threatens to bury homeowners and investors alike under a mountain of devalued assets and missed opportunities. The numbers don't lie. Housing-related stocks have plummeted across the board, with industry giants like Lennar Corporation down a staggering 35%, D.R. Horton down 22.5%, and Pulte Group down 23.3% in just 1 year. Meanwhile, Home Depot's technical indicators have turned bearish in both short and long-term outlooks, with the company explicitly stating they're not assuming a change in the rate environment nor improvements in housing turnover. In today's video, we're going to dissect Home Depot's warnings and what they mean for us as a homeowner or investor. We'll examine the hard data behind these statements, analyze the ripple effects throughout the housing market, and provide actionable strategies to protect your wealth in what could be one of the most significant economic downturns of our generation. Let's dive deeper into what Home Depot executives are actually saying. In February 2025, CEO Ted Decker didn't mince words in the company's fourth quarter earnings report. He pointed to ongoing pressure on large remodeling projects and blamed the lackluster demand on uncertain macroeconomic conditions and a higher interest rate environment. Bill Bastek, Home Depot's Executive Vice President of Merchandising, reinforced this message during their earnings call, stating that the higher interest rate environment is still pressuring larger-scale remodeling projects. He noted that despite seeing broader engagement across home improvement-related projects, the big-ticket items that drive significant revenue are in trouble. What's particularly telling is how consumers are behaving. Bastek observed that for those who are doing projects, many are turning to flexible financing options. He said, "We continue to see softer engagement and larger discretionary projects for customers who typically use financing to fund the projects, such as kitchen and bath remodels." Translation: Americans are so cash-strapped that they can't afford major home improvements without going into debt, and many are choosing to postpone these projects altogether. This isn't the first time Home Depot has warned about economic trouble. Back in August 2024, the company lowered its sales expectations for the year, with Decker citing higher interest rates and greater macroeconomic uncertainty that were pressuring consumer demand more broadly. At that time, sales at stores open at least a year had dropped 3.6% in the second quarter, and the company projected a 3 to 4% decline for the year, significantly worse than their earlier estimate of just a 1% drop. Let's look at the cold, hard numbers that support Home Depot's dire outlook. As of our most recent data, Home Depot stock, HD, is trading at $345.24, well below its 52-week high of $439.37. That's a 21.4% drop from its peak, representing billions in lost market value. Both short-term and long-term outlooks are bearish, with analysts noting that recent bearish events outweigh bullish events. Home Depot isn't alone in this downward spiral. Let's examine how other housing-related stocks have performed over the past year. Lennar Corporation down 35.13% from $155.22 to $100.70. D.R. Horton down 22.5% from $147.80 to $114.55. Pulte Group down 23.3% from $117.32 to $89.99. Toll Brothers down 26.66% from $121.64 to $89.21. NVR Inc. down 10.17% from $7,680.73 to $68.99.72. Lowe's Companies down 2.91% from $221.29 to $214.86. These aren't small fluctuations. They represent a sector-wide collapse that's erasing billions in investor wealth. And remember, these companies aren't just abstract entities on the stock market. They're the builders and suppliers that construct and furnish American homes. Meanwhile, the housing market itself is showing troubling signs. According to the National Association of Realtors, the median price of a previously owned home in the United States rose to $426,900 in June 2024, up 4.1% from the previous year. This might sound positive, but it's actually problematic when combined with high mortgage rates. It's creating an affordability affordability crisis that's locking potential buyers out of the market. Speaking of mortgage rates, they've been hovering just under 7% for months, more than double the record low rates seen during the pandemic. This dramatic increase has devastated affordability. Consider this: on a $400,000 home with a 20% down payment, the monthly payment at a 3% rate would be about $1,349. At 7%, that same mortgage jumps to $2,128, an increase of nearly $800 per month or $9,600 per year. One of the most fascinating and troubling dynamics in today's housing market is what economists are calling the golden handcuff effect. Home Depot executives specifically mentioned this phenomenon, and it's critical to understand why the housing market is so dysfunctional right now. Here's how it works. During the pandemic, mortgage rates plummeted to historic lows, with many homeowners securing 30-year fixed rates below 3%. Fast forward to today, with rates around 7%, and these homeowners are effectively handcuffed to their properties. Why would anyone trade a 2.8% mortgage for a 7% one? Math just doesn't work, even if they'd otherwise prefer to move. This creates a vicious cycle. Homeowners who might normally sell their homes and upgrade, downsize, or relocate are staying put. This severely constrains housing supply, which keeps prices artificially high despite weakening demand. According to recent data, housing inventory remains near historic lows, with months' supply of homes well below the 6-month supply that indicates a balanced market. The ripple effects are enormous. First-time homebuyers are finding themselves priced out of the market entirely. Move-up buyers can't find suitable homes to purchase. And perhaps most relevant to Home Depot's warnings, homeowners are increasingly choosing to renovate their current homes rather than move. But even those renovations are being scaled back or postponed due to high costs and economic uncertainty. This golden handcuff effect also impacts labor mobility. When people can't afford to move for better job opportunities, the entire economy suffers from inefficient allocation of human capital. Companies struggle to attract talent from other regions, and workers miss out on career advancement that might require relocation. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now let's continue. If you're considering buying a home in this environment, you need to approach the market with extreme caution. Home Depot's warnings, combined with the broader economic data, suggest we may be approaching a significant correction in housing prices. First, understand that we're likely at the tail end of a housing bubble inflated by pandemic-era policies. Ultra-low interest rates, massive stimulus payments, and work-from-home trends created abnormal demand that pushed prices to unsustainable levels. As these factors reverse, a correction becomes increasingly likely. However, this doesn't mean you should necessarily wait indefinitely. Housing is highly local, and some markets will be more resilient than others. Areas with strong job growth, limited supply constraints, and reasonable affordability ratios may weather the storm better than overheated markets where prices have far outpaced local incomes. If you decide to buy, consider these strategies. 1. Increase your negotiating leverage. In a weakening market, sellers may be more willing to make concessions. 2. Build in a safety buffer. Avoid stretching to the absolute limit of what you can afford. 3. Think long term. If you plan to stay in the home for 7 to 10 plus years, you'll likely ride out any temporary downturn. 4. Consider adjustable rate mortgages with caution. While they offer lower initial rates, they could become problematic if rates remain high. 5. Look for motivated sellers. As the market slows, some homeowners will need to sell regardless of conditions. Remember, Home Depot's warnings aren't just about their business. They're telling us something fundamental about consumer confidence and economic health. Real estate investors face a particularly challenging landscape in light of Home Depot's warnings. The traditional buy and flip strategy becomes significantly riskier when home prices may be peaking or declining. Similarly, the calculus for renovation projects has changed dramatically. Let's start with renovation ROI. Home Depot's observation that consumers are postponing large renovation projects isn't just a problem for their sales, it's a signal about diminishing returns on improvement investments. Projects that might have added significant value in a hot market may now barely recoup their costs. According to Remodeling Magazine's Cost vs. Value report, even before the current slowdown, many major renovations were returning less than 70 cents on the dollar in terms of home value increase. For fix and flip investors, this means tighter margins and greater risk. The days of quick, profitable flips with minimal improvements may be behind us for now. Instead, successful investors will need to 1. Focus on necessary repairs rather than luxury upgrades. 2. Target distressed properties with significant discount potential. 3. Run conservative numbers that account for potential market declines. And 4. Extend holding period expectations to wait out market turbulence. For long-term buy and hold investors, the current environment actually presents some opportunities. While home prices may face pressure, rental demand typically increases when buying becomes less affordable. This could lead to stronger rental yields, especially in markets with strong employment fundamentals. Alternative investment strategies worth considering include multifamily properties, commercial real estate in recession-resistant sectors, real estate debt investments, and REITs focused on sectors less correlated with housing. Perhaps most importantly, investors should be building cash reserves. If Home Depot's warnings are indeed signaling a broader economic downturn, having dry powder to deploy when assets are truly distressed could be the most profitable strategy of all. Based on Home Depot's warnings and our analysis of the housing market, here are specific steps you can take to protect yourself and potentially capitalize on the changing economic landscape. For homeowners, 1. If you have a low-rate mortgage, think twice before refinancing or selling unless absolutely necessary. 2. Prioritize maintenance over discretionary improvements. Fixing a leaky roof is essential. Adding a luxury kitchen isn't. 3. Build an emergency fund that could cover 6 to 12 months of mortgage payments. 4. Consider a home equity line of credit, HELOC, while you still qualify. 5. If you're planning to sell in the next 1 to 3 years, consider accelerating those plans. For investors, 1. Stress test your investment properties. Could you survive if rents declined 10 to 15% or if vacancies doubled? 2. Lock in long-term financing where possible. If you believe we're headed for economic trouble, fixed-rate debt is valuable. 3. Diversify beyond real estate. Home Depot's warnings suggest systemic economic issues, not just housing-specific problems. 4. Look for counter-cyclical opportunities. Home maintenance businesses, affordable housing, and property management often perform well during housing downturns. 5. Be patient with new acquisitions. If Home Depot is correct about economic troubles ahead, better buying opportunities may emerge in the next 12 to 24 months. Financial experts suggest we may see the housing market bottom out sometime in late 2025 or early 2026, assuming the Federal Reserve begins cutting interest rates in response to economic weakness. Home Depot's warnings about the economy aren't just corporate caution. They're a glimpse into the financial health of American households and the stability of our housing market. When a company that literally builds its business on American home ownership starts sounding alarm bells, prudent investors and homeowners should listen carefully. We've examined the hard data behind these warnings: declining sales in home improvement, plummeting stocks across the housing sector, high mortgage rates creating golden handcuffs, and technical indicators pointing to continued weakness. The picture that emerges isn't pretty, but forewarned is forearmed. Whether you're a homeowner concerned about preserving your property value, a potential buyer trying to time your entry into the market, or an investor seeking to protect and grow your wealth, the strategies we've outlined today can help you navigate these turbulent economic waters. Remember, economic cycles are inevitable. The housing market has faced corrections before and will again. Those who prepare thoughtfully, maintain financial flexibility, and make decisions based on data rather than emotion will not only survive, but potentially thrive in the changing landscape ahead. If you found this analysis valuable, make sure to subscribe for our upcoming video on specific markets that are most vulnerable to the economic warnings Home Depot has signaled. Please share this with a friend and watch this one as well.